Hey everybody, this is Alex Merced and you're listening to Mastering Financial Exams. And I'm one of the instructors here at Greco Financial Training. You can check us out at greco.com. That's Greico.com. And basically what this podcast is for is just introduced concepts that are very typical to many securities licensing exams, like the Series 24, the Series 7, etc. Now today we're going to be talking about mortgage-backed securities, otherwise known as asset-backed securities. These are debt instruments. You are basically creating a security out of debt, but these are very unique. While your traditional bond basically says, hey, you're lending me this much money and I'm going to pay you this much interest per year, and pays you sort of a coupon or interest payment, asset-backed securities don't pay you a fixed amount. What they do is they pay you a fixed percentage of money that's coming in from a basket of debt. So imagine that I take a whole bunch of mortgages, a whole bunch of loans, and put them in a bucket. All the people who took out those mortgages are going to pay on that mortgage every month. So much money is going to come from all those mortgages every month. So anyone who owns one of these mortgage-backed securities will get a percentage of that money from all those mortgage payments every month. But that doesn't have to just be mortgages. It could be car loans. It could be credit card loans. It could be student debt. It could be any of these things. So when you use non-mortgage debt, it's referred to as an asset-backed security. It's backed by a basket of loans. And the idea is that when you buy one of these asset-backed securities or mortgage-backed securities, you are getting a portion of the monthly payments on those debts. Now, what are the risks when you have these kinds of instruments? Well, you have a risk that the people who own these debts pay them off early. So in that case, they're not going to generate as much interest as you may have initially expected. This is called prepayment risk. This is very typical when interest rates go down, because when interest rates go down, people will refinance their mortgage, refinance their small business loan. They're going to start refinancing, which means they're going to pay off that old loan they used to have, which is the one that's in your instrument, and have a newer loan that's not part of your instrument at a lower rate. So you're going to get your money back early, and then when you go to reinvest it, you can only find new ones at lower rates. So that kind of sucks. The opposite problem is if rates go up. This is called extension risk. So the idea here is interest rates go up. Now there are new credit card loans and new mortgages that are being offered to people at higher rates, which they make new asset-backed securities or new mortgage-backed securities out of. Problem is, you can't buy them because your money is still tied up in the old ones, because those people aren't going to pay their loan back early, because why would they want to pay back their loan early when interest rates are higher on new debt? So bottom line is interest rates don't stay still, so one of these things is bound to happen when you own one of these. So what they've done to kind of insulate the risk is they created the idea of tranches. So instead of everyone just sort of buying a fixed percentage of the money that comes in every month, what they do is they split up the interest and principal. So every month when people pay their payments on their loans, everyone gets their share of the interest, but the principal portion of the payment will go to the most senior tranche. So there'll be several different groups or tranches, and the most senior tranche is the tranche that gets paid first. So all the principal will pay that tranche first each month until that tranche is paid off, and then every month going forward, it'll go to the next tranche, to the next tranche, to the next tranche until the whole thing is paid off. So everyone's getting a little bit of interest every month, but only the most senior tranche is getting the principal each month. So it allows you to buy a tranche based on when you would like to get paid back. So if you want to be getting paid for a longer period of time, you can buy a more junior tranche, while if you want to get paid quickly, you can buy a more senior tranche that's going to get their principal back faster. So that's essentially the basic idea behind asset-backed and mortgage-backed securities. You're just taking a basket of loans and saying, hey, money's coming from these loan payments every month, let's distribute them to securities holders, and selling a security that does exactly that. So I'll leave it at that. I'll talk to you guys later. This is Alex Merced from Greco Financial Trading. If you want to take a look into our online courses and you want to see a demo of the courses, go to greco.com/demo. That's greco.com/demo. You can see a demo of all our products and learn a little bit more about what we do to see if you'd like to learn more. Talk to you then.